Welcome to TheoTrade. This is Don Kaufman. May 11th, 2020, seconds to go to the cash close with the S&P futures, well, massively unchanged in today's trading session. And you know, the marketplace continues to be defined by this incredibly tight yet volatile trading range, which of course we've dubbed the volatility box. Right there, you're looking at a 30-day, 1 hour, and you are now well into the fifth week of trading inside of precisely the same range inside of the broader markets. But time out for a second. Something has changed on your screen. Can you see what it is? And when I say something has changed, I'm not trying to be facetious in here. A few really key details have actually changed in this market. As we're coming close to the cash close, you can see the S&Ps, they're backing off a little bit and possibly right back to the 2911 gravity point here. I would expect the 2911, of course, would make an appearance in some of the after hours trade. But that, again, hasn't changed. That's just part of the range. And here we go into the closing bell of this session. Let's cut to the chase. What has changed in here? One of the first things that you have to notice is if you take a look at the volatility, and specifically the volatility futures contracts. Now, the 9-day volatility future contract, in my opinion, it's toast. It's not really worth looking at. So you want to start to look at volatility futures that are approximately 37 days out. So take a look right there. And again, I just wanted to draw your attention, because now we're actually going to highlight specifically all your volatility contracts. Look right there, 37 days out, they're trading at 29. And if you jump out to 72 days, they're actually jumping to 29.35. This is the first time, really the first time in now weeks and weeks since effectively this crisis kind of kicked off that we've actually seen volatility start to normalize. What we've seen since the beginning of the crisis, and really, in February and effectively March, we saw a volatility flip over. And the volatility has been inverted. And what that means is short duration like June. This is the June with, for instance, 37 days. Then we go out a little further. We come out here to 72 days, come out a little further to 100 days. Now, the 37-day, this thing was trading at like 35 last week. This one would be like, 34 and change. And I'm just throwing some, arbitrary numbers up there so you can understand that volatility was completely flipped. And what that means is when the shorter duration, is above, the longer duration, effectively that means risk is prevalent right here. I mean, 37 days is actually displaying, for example, more risk than 72 days. But all of a sudden here, we've actually snapped back, and today is the first day, we've snapped back very mildly, to a much more normal, volatility skew. And that is the shorter durations trading now at 29. You go a little further out here, 29.35 and so forth. So that is in stark contrast to what we've seen in some of the recent trade, and really anything that we've seen pretty much since the coronavirus kind of gripped hold inside of the marketplace. However, even though that the volatility futures have normalized, and people are like, that's a very bullish indication. Normally it would be a very bullish indication, but unfortunately we have two highly conflicted areas of this marketplace, and that's this. If I scroll down to the bottom of the screen, take a look at the VVIX. Ironically today, the VVIX, that's the volatility of the volatility index, happens to actually be bid back up. Now, even though the volatility futures have come off and the volatility futures are saying it's okay to come back out, the VVIX is saying the exact opposite. What you're seeing in the VVIX, is indicative of it. It's only up about 2%, but it's bid. And anytime the VVIX is bid, and more appropriately, anytime it's above 110, it kind of means the market's in a bit of turmoil. But the VVIX, what it indicates is that traders are coming in there, and they're actually buying volatility in the VIX right now. Again, they're buying volatility inside of the VIX, which should leave you with the idea that, that's just not warm and fuzzy. And you can see I've got a lot of different positions in the VIX right now. I'm actually, slated for, volatility Armageddon inside of some of my VIX positions. So the first thing that's really changed on the screen is, yes, the volatility futures have kind of normalized. They've dropped back into, again, a much more normal feel where, again, front vol is ever so slightly lower. Now, if you have 1 day of sell side activity, that's going to be all gone. But at the exact same time as they're saying it's okay to come out, the same time, you're looking at the VVIX and you're like, danger, danger lurks. Okay. The other major change inside of today's marketplace, it's got to be the bonds. All right. The bonds, they're starting to trade again. And this is something that I have cautioned day in and day out. If you're not watching the bonds right now, okay, you're missing the much bigger picture inside of this marketplace. The bond volume, okay, is just ever so slightly higher than it was in some of the previous weeks. Why? Because it's finally started to move, okay, well, one direction to the other. Right now, that direction happens to be down. Now, I was talking about in this weekend's video how tight, okay, this channel happens to be. It's not that dissimilar, though, to what you've seen inside of, well, the entire marketplace. I mean, the S&Ps are in a tight channel. The bonds are in a tight channel. Okay, I was talking about this in the weekend video. The dollar, okay, the dollar is in an incredibly tight channel. I mean, you pretty much name it. You want to go to what? Want to go to gold? It's in a tight channel. Okay, I can go on and on all day. But the bonds at this point in time, because there's some volume starting to pick up and they're leaning down a little bit, I'm finally starting to feel like the bonds might come out of their little shell over here. And again, I'll take it. I'll take any uptick inside of the volume, okay? Because the bond market, it's needed at this point to spark the S&Ps out of the range. And again, we're in this range, and this range in the S&Ps. And if you're much more into the S&Ps and you're more worried about the your positions in stocks and so forth, then yeah, this range should absolutely be influential to everything that you're doing, because that range, it's not just about continuing to define the marketplace. It's going to define everything that you do. You have to be so critical of wanting to continue to allocate capital at this point in time. Now, with that, we continue to also see some sector rotations, and this is pretty transparent. This is something that's been going on nonstop, and that's there you got the financials. The financials closed down by the tune of 2%. They're taking a beating. Now, financials, were not enough to necessarily pull the S&Ps too far underwater. Again, mildly, yes, but not necessarily enough. But the financials plus the energy sector, well, that does it for me. And that's actually why the S&Ps closed down, because at the same time, the monsters of tech up about 1%. The interesting thing is you really do. People have been talking about this, but I think they kind of speak a little bit tongue in cheek. You really do, though, have 5 stocks that are driving this marketplace. I mean, you can level the playing field by looking at Microsoft and Apple, and Facebook and Amazon and Google, because there's a lot of even technology-related stocks today that are nowhere near up, by the tune of 1%. I mean, just take a look over at the Nasdaq. The thing's only up 0.6% on the trading session. It's all about the Microsoft, the Apple, the Facebook, the Amazon, and that not only should be a concern, it is the concern. And for those of you, again, if you're aware of some of the positions, I'm still carrying negative deltas here. And today, when you're thinking about like negative deltas, like, oh, you're getting killed, it's not an up day. I mean, the S&Ps are, the S&P's down 9. I consider that as largely unchanged, but they're kind of just backing off once again, right towards that 29.11 gravity point. I mean, for me, in my own positions, so long as we're inside of this volatility box, we've done nothing. All we're doing right now is pinging back and forth between some of our gravity points, and we're doing nothing. We are looking for, this week, the crack of the volatility box. Again, we've had a couple of weeks. We've been inside the expected move. I think you have to recognize we're still trading, again, right near a 30 VIX, but the S&Ps have just channeled back and forth, roughly speaking, between, again, kind of a lower gravity point over here. Now, so everybody can see specifically what gravity point we're referencing in this case. We're talking about the 2731. I'll snap back over here just to the larger time frame. Right down there's the 2731. That's kind of the lower edge of our, of course, volatility box. The upper edge, I mean, I really think we have to put that upper edge in this neighborhood here of about the 2982. Once again, another gravity point to the upside. And until, again, we crack that range, it's a little bit of the status quo. We're seeing sector rotations and so forth. Yes, we're seeing great degrees of correlation at the onset of the trading day. But hey, at the end of this trading session, you got yourself a veritable slop fest. Again, Look for volatility to kind of grip hold. Look for the bonds to make more definitive moves. That's what we need to see again to break this range. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.